We've got Bob Iaccino joining us this morning, founder, chief strategist of Path Trading Partners. Bob, good Wednesday morning to you. No numbers at the bottom of the hour for us to break down. And before we talk commodities, just kind of overall bigger picture, what's got you fired up this morning? I mentioned stocks, new all-time highs. You got rates, which are pulling off a bit. The dollar back below 103. Where's your attention as you turned on your platform?
It's turned on the small and medium-sized business PMIs that we got overnight. We got Germany, we got UK, we got EU, and we're going to get the US at 9:45 Eastern time. And the manufacturing side of that is moving up. Now, every country I mentioned still in contraction. Remember, these are small to medium size. These are not the ISM style numbers, where it's the huge corporations. But small to medium size is relative, right? You can be talking about businesses from 50 million to 500 million will fit in there. And we don't really know what the survey looks like in terms of who they survey, but it's not large corporations. And you're seeing the manufacturing PMIs creep up. Every one of those countries I mentioned is still in contraction, but they're less in contraction than they were last month at the last reading. And these are preliminary figures. So they could get revised, and they're also early 2024 figures. So that's a good sign overall for me. And I think this particular equities going to new highs is definitely warranted in the short to medium term.
Bob, I'm looking at the numbers here. I've got, looks like Germany manufacturing PMI came in at 45.4. To your point, still in contraction, but well above the 43.7 they were looking for. Prior was 43.3. Eurozone, it looks like the PMI, the manufacturing came in at 46.6, well above what they were looking for, 44.8. Prior was 44.4. And as I look at the UK manufacturing PMI, also topping prior and expectations. And along those lines, it wasn't just Europe. Now that I think of it, I'm reminded of how Japan and Australia also had their numbers, PMI numbers out overnight. Japan's manufacturing PMI at 48. That was up from 47.9 in December. But that's been in contraction below 50 since October of 2022.
Yeah, it's been a big manufacturing pullback. But the thing about manufacturing is it correlates very highly with the broader economy, despite, for example, the US being 60 to 70% services, depending on the season. And obviously, recently, the US has been driven by services, probably on the high end of that range, maybe even higher. But manufacturing, when you look at the data, it correlates very well with the trajectory of the economy, somewhere in the 93 percentile with GDP. So you want to see manufacturing. The ISM is the one that I talk about specifically in the US that correlates so highly. But you can't turn a blind eye to the idea that manufacturing is getting better in that small to medium-sized business sector, which is where most people are concerned, despite what many may believe that is still the job-creating engine. So if you have a strong labor market, and the job creating engine is getting stronger, I would suggest, similar to Paul, that the market is pricing in way too easy of a Fed, way too easy. Now, also add to that the 2's 10-year yield curve inversion at its highest level since October 26th, yesterday on a settlement basis, negative 17. October 26th was a negative 16. Remember, we were negative 109. So two things on that, since you're asking me what I'm looking at. When that turns positive and starts to actually steepen into what we'll call normalcy, where the 2-year yield is below the 10-year yield, we actually start to see a stock market bottoming at that point. Now, I'm not saying a stock market fall. I'm saying a bottoming, meaning that if we're at new highs, when that happens and it continues to steepen, this is a new bull market. I'm talking about a multi-year bull market.
That's actually very positive in many ways because one could argue
and I'm not usually like that.
Yeah. Let's talk a little bit about here, Bob, in terms of this data. One could argue all of this very good, right? Strong labor conditions, the manufacturing numbers suggesting that the economy remains very strong because we need that in many ways if the economy is going to stomach these higher rates. So I think maybe that's what the bulls are cheering on here in some ways, this environment. Speaking of crude oil around 74, I mean, that's something to cheer on in many ways, considering the developments in the Middle East and the level-headed approach that we've seen to the situation that's going on there. And also, again, that contained price activity, I would argue, supportive of these higher prices we've seen in terms of stocks and this bullish environment, this optimism abound tied to the economy in general.
Well, I would agree with that, and I'm glad you brought up crude oil. So number one, in terms of the optimism, I still think stocks are optimistic, expecting rate cuts, which they shouldn't be, but they are. So we follow the trends. I think if you got 5 rate cuts, which remember the market was pricing in 7 a couple of weeks ago. Now they're pricing in 5. That's a little bit more healthy of a pace. But you look at it from that perspective, if they don't get these rate cuts, does the market fall? And if it falls and the 2-10s inversion continues to move to positive territory, that's the drop you buy and you hold it for 5 years. Now, adding to that, you mentioned crude oil. Crude oil seems to be starting to base in this area. Now, we're still in the channel, save for a small period of time where we popped above it. We're still in a channel that we've been in since October of 2022. Now, it's a 25% channel. It's a $17 channel, but it's still a sideways channel. And we got an OPEC meeting next week. And there's been no hints that OPEC is going to be aggressively cutting production. As a matter of fact, I think Saudi Arabia is sick of being the only one who will do it. So you add to that U.S. production, and a note on U.S. production, the largest percent in history of U.S. production has been heavy crude, around 2.58 million barrels. That's unusual. And what that means is they're getting to the end of the life of some of these shale rigs, and rig counts are not increasing. So you could see this sort of double-edged sword of crude oil prices rising by OPEC getting more aggressive. Again, I don't think they're going to. But as you see this heavy crude oil come out of these wells, that's nearing the end of the life of the high productivity of these wells. Also, high viscosity crude goes slower through pipelines and costs more to ship. So they have to adjust the price of crude oil down because crude oil is sold in what we call plus pipe. So if you use WTI as the baseline, WTI plus pipe means WTI plus shipping costs. So WTI has to drop or the crack spread widens, mean people will be complaining about the price of fuel at the pump compared to the price of crude oil.
I'm hearing inventories are going to be a little bit out of whack this week with the colder temps that we saw over the last couple weeks. API yesterday reporting a draw of 6.6 million barrels. They do have looks like a small draw expected for the EIA today, 2.15. But Bob, I didn't have OPEC on the radar, so appreciate you bringing that to our attention. We'll keep an eye on that next week as well and continue to watch crude prices at current levels. Bob Iaccino, founder, chief strategist of Path Trading Partners. Thanks for joining us this